If we were to talk about profitability just from a base level and you think, well, what makes a company profitable? Probably what's coming in your mind is like, well, profit margin, right? We sell goods and services and we get money in return for those, and we want to sell our goods and services for more than it costs us to produce or make those goods and services. And thus that difference between what we sell and what we cost to make it happen is our profit margin, right? And we make that margin on every sale. And that's a key ratio to look at, is what is a company's profit margin? You can get that from the income statement. The formula is, looking overall, the formula is net income divided by its sales, right? So we're looking at how many sales we're making in terms of dollars, and then what's our net income coming in, and dividing that net income divided by sales will give us our profit margin. How much are we making basically per sale? And we want to have good profit margins. The higher the number, the better, right? That's something pretty basic there. And this company is kind of calculating, how well your sales are flowing through to the bottom line. If you make a sale, but you don't make much profit on it, it's not going to the bottom line that can then be used to invest in other equipment or invest in things, or used maybe to pay out dividends or pay out things to the shareholders or buy stock or whatever it might be. So higher margin is better, and higher profits are always better for shareholders too. And is that profit margin increasing, staying the same? Is it going down? Those are some things you want to look at. One thing that's very, very important, as I mentioned, all the ratios, I talk about how important it is to compare within this industry. But with profit margins, it's extremely important to compare within this industry, because different industries, by their nature, have higher profit margins than others. For example, large grocery store chains, where you can buy lots of food at a grocery store, or maybe retail is a similar way. Retailers, they run a very low profit margin. They make their money by selling lots of goods, and they have that low margin, but a lot of it gets to the bottom line because they're just selling so much of it. Think of it like Walmart or these large Target, these large retailers. That's what they do, is they don't make much per sale, but they have a lot of sales. Versus, let's say, a company like Google or some of these technology companies, Microsoft, they have very high profit margins. They don't necessarily have to make as many sales because they're carrying less inventory or goods, or their costs or their expenses are lower in comparison to other industries. So compare within the industry is very important, because you might have a company that has what looks like to be a great profit margin, but in its industry it might be actually very low and a very poor, underperforming potential stock, versus maybe somebody in a lower profit margin industry that might be a good stock, especially for the long term. But overall, profit margin is about how money flows to the bottom line. So as shareholders, we like higher profit margin, and many people just like to exclusively invest in companies that have higher profit margins. It gives them a little more room to error. But remember, if you're not making sales, you're not making profit either. So it's that dance between what are you selling stuff for, the price, and then what's your cost, and how much is the spread between. But from an investor standpoint, the higher the profit margin, typically the better. But just make sure you compare within the industry and amongst other factors that you might be using when you're evaluating stocks.